Hello and welcome back to Lipper's Fund Flows Insight Report. I'm Jeff Turnhoy. Well, after a 2-week hiatus, we're back and more ready than ever to talk about flows. For the week ended May 29th, 2013, the conventional mutual funds industry saw inflows of about $1.7 billion. Let's take a look at our macro groups and see where the activity was. Starting off at the top, equity mutual funds saw about $517 million in net inflows. Taxable bond funds had about $1.3 billion. Municipal debt funds had outflows of just over $140 million. And money market funds had inflows of $13.5 billion. Well, there wasn't a whole lot of news to go on this week. It was a holiday-shortened week that may have dampened investor enthusiasm to make any changes to their allocations, which might explain part of the light flows totals this week. Another explanation could be that investors are concerned that the Fed may be getting ready to pull the punch bowl away from its stimulus plan. As you know, they've been buying about $85 billion in bonds every month for the past couple of years, and so this has led to a very low interest rate environment, thus stimulating the economy, we're told. And now that the economy is getting closer to standing on its own 2 feet, maybe we don't need so much stimulus anymore. Well, time will tell how and when the Fed takes any action on this current plan. Well, let's just jump right into those equity fund flows now. As I mentioned earlier, they had total inflows of about $517 million. Now, this came despite a fairly tepid result in the markets. We saw about negative 74 basis points in activity as far as total returns go. So overall, there wasn't a strong reason for investors to jump out of the market, and neither was there a good reason to get in. We saw the lightest activity of the year this week for equity mutual funds. Again, $500 million is probably about one-fourth of one of their lightest weeks yet. So it came as a bit of a surprise to see investors slam on the brakes so hard this week. Domestic equity funds were clearly favored over non-domestic. So the domestics took in just about $600 million, while non-domestics had slight outflows, called about $67 million. Interesting change of pace here. Large cap core, international multi-cap core tended to be the biggest recipients of flows this week, which is quite a change from the past when we saw equity income and a more specific income-oriented strategies tend to take in better flows. We saw outflows this week from emerging markets as well, so that really showed where investors are kind of starting to let off the gas a little bit as far as their risk-on attitude. Well, let's take a look at the equity ETF side of the business. Here we saw about $1.1 billion in outflows for the week. Of course, this would be led by SPY when people are starting to turn sour on equity ETFs. SPY is usually the first place they sell. We saw the best inflows come from the Select Spider XLF, which is focused on the financial services industry. It took in about $533 million this week. The two sizable Japan-focused ETFs, DWJ and EWJ, collectively took in about $440 million, which was far below what they've taken in over the last couple of weeks, where $1.5 billion was more the norm. So perhaps investors, again, starting to pull back a little bit on those ex-US and specifically Japan, as well as emerging markets in their investment decisions. We'll see how long that behavior continues. The next group to take a look at is taxable bond funds. $1.3 billion this week was their lowest of the year as well. This comes after 3 consecutive weeks of downside performance. So perhaps investors are starting to believe that interest rates are rising and maybe heading further north as into the near future. So far, we've seen the 10-year benchmark go up over 2.1% in yield. This has really put a damper on taxable bond fund performance. So maybe this is causing investors to pull back a little bit on their enthusiasm for taxable bond funds. Loans continued to be the standard bearer this week. They took in about $838 million, which was pretty good for them. Elsewhere, high yield funds tended to see outflows. So as a consequence, when we look at the best draws as far as individual mutual funds, the Eaton Vance floating rate took in considerably more than a lot of the other funds out there. It's a loan participation fund. On the negative side, the Neuberger Berman High Income, which is focused on high yield, saw outflows of about $400 million this week by our estimates. So we can really see where the market is starting to divide itself into loan participation as a buy, high yield as a sell. This has been going on for a while and seems to be locked in place for now. When we take a look at fixed income ETFs, we get a very different view of things. They had outflows of about $1 billion this week. They've had 3 consecutive weeks of outflows in this area. High yield, tips, treasury products all were outflows. The only ones that really showed appreciable inflows, again, the loan participation group, senior loan ETFs took in money. The PIMCO Ultra Short Obligation Strategy Fund, which is known as MINT, M-I-N-T, also had decent inflows for the week. Beyond that, not a whole lot of activity to write home about. The next group to take a look at is municipal debt funds. They did have outflows this week, $140 million or so. This is their first outflow in the past 3 weeks, and this comes despite 4 consecutive weeks of downside performance. So investors may be starting to question how long they want to stick with their municipal debt funds, whether this $140 million outflow is just a blip or the start of bigger things to come. Well, we'll have to wait and see. But for now, we see most of the interest in inflows. There still are some spots of inflows, but they're going into intermediate and short-term municipal debt. So investors are wanting to take a little bit off of the interest rate risk as long as they're going into municipal debt funds. High-yield municipal debt actually had outflows. Some of them are more a product focus and not a general trend, I would say. And the last group to take a look at is money market funds. Again, $13.5 billion in inflows. This was due almost entirely to institutional investors. They put about $13.4 billion to work in money market funds, while the retail investor had only $134 million in inflows to money market funds. So your retail investor, when it comes to mutual funds, really didn't put much money to work this week in equity funds or taxable bond funds or municipal debt funds or money market funds. So it's really an overall quiet week for retail investor activity. Well, join us again next week where we'll talk more about flows activity inside mutual funds and ETFs, or join us online at lipperusfundflows.com for more up-to-date information. Thank you.